The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to today's webinar on using stock options to build your startup team before venture funding. Today's November 14, and I would like to thank everyone for joining us this afternoon. Before we begin today's session, I'd like to let everyone know that we will have a Q&A session at the end. All you need to do is type in your questions in the questions box of your GoToWebinar control panel, and you will find that panel on the right side of your screen. You may type in your questions anytime during the webinar, and we will queue them up towards the end of the lecture. The one thing that I'd also like to let everyone know, if you have colleagues that wanted to join the webinar but were unavailable, we will make the video and the slides available to everyone on the call. So as long as you're registered to this webinar, you will receive an email from us after the session concludes with the links to the video as well as the links to the slides. All right, without further ado, I would like to introduce today's speaker. He's the Executive Director of the National Council of Entrepreneurial Tech Transfer. He was previously from George Washington University, the Director of the Council for Entrepreneurial Tech Transfer and Commercialization. He worked on in the Securities and Exchange Commission, and as well as he appeared in front of the U.S. Congress as well as other agencies to talk about entrepreneurship and startup creation. So now I'd like to present to you our speaker today, Tony Stanko.
Thank you, Ria. Hello, everyone. I'm just waiting for, okay, show my screen. Here we go. All right, hopefully you're seeing my screen at this point.
All right,
okay, here we go. So, So this webinar is about using stock options to build your startup team before venture funding. Okay, a little background. So NCET2, so I'm the executive director of the National Council of Entrepreneurial Tech Transfer, NCET2. So we have a startup development program, and our mission is to discover, develop, and fund corporate aligned startups, mostly from universities, angel groups, federal labs, and state funding agencies, but specifically aligning these startups to corporate business units. So basically the model is startups do the R&D, research commercialization, product testing, and market testing, and then the corporates do scale up marketing, manufacturing, distribution, and sales around the world. So everybody, the startups specialize in the innovation, and the corporates specialize on the scale up. Here's some startup services we do. This might be interesting to some people on the call. So we will incorporate startups and set up the stock option plans in exchange for some equity. We can provide startups, especially very young startups, with startup development officers to help find team members and to develop the business. We will also, if the startups are interested, put the corporate startup finders program in place for them and help find startup research or sponsored research, licensing, joint venturing, and strategic alliances from our corporates for the startup. And we also have an investment group called the National Angels USA that will fund startups that come out of this corporate alignment. All right, so this particular webinar will cover why stock options are so important for venture-backable startups and how to use them to build your team so you can receive funding. Basically, a lot of entrepreneurs start a company and they believe that investors will fund them on a business plan or because they have a patent. That's generally incorrect. There's some exceptions on the West Coast in the software internet space, but for most startups, investors need to see a team in place. They actually need a team that they strongly believe can execute on the business plans to deliver the promises in the plan. and not the plan themselves. So it's really important to have a team. A lot of entrepreneurs say, well, say to the investors, well, give us the money and we'll hire the team. But that really is not how it works. You have to have the team in place so the investors can analyze the team along with the business plan and see if it's going to actually deliver. So the dilemma becomes, how does the startup create the team? Well, this is where the stock options come in. So to build the startup team, specifically for venture funding, you start with the founder, the entrepreneur who has a vision, employee number one, and then their job is really to find the next 2 to 10 employees. That's really the main job. I mean, it's coming up with the business plan. Probably it's actually coming up with the vision more than the plan, because employee 2 and 3 should really be helping to set up the plan. But yeah, you need somebody who takes the initiative. That's the founder entrepreneur. That's employee number one. And then you need to start, creating value. So those are the first couple of employees, help build up the plan, make sure that it makes sense. Then after that, you need employees to start executing on parts of the plan. Employees 1, 2, and 3 usually help to do that too. They wear multiple hats, especially the first 5. But you need to have employees. You just can't, as I'm sure everybody knows, start doing things without having people doing the work. It's important because sometimes I hear from startups and they think, well, if I get the money, I'll just hire some employees or get some consultants. That's really not what investors are looking for. What they're looking for are people or members that believe enough in the founder to take below market rates to help build the company. So that's really the important thing. It's not a regular employee that just comes in and does their 9 to 5 and goes home without worrying about it. I mean, you might be able to put that in place once you get large enough, but the early employees, they're really partners more than anything else. They're not necessarily structured like that, especially if a lot of them are not taking on a lot of the risk. But it's not uncommon to have 1, 2, 3 early people, kind of founders rather than just one. But you at least need one, but you might have a couple more that really take the big burden, the big risk, that become full-time. So these are not employees. So what happens is, to be fair to these startup members, you really need to overcompensate them later because they're not getting, market rates now. And that's what the stock options do. So that kind of frames the discussion here, what we're trying to do. Find employees that will be able to start working on the company before the company gets fully funded. So stock options really are how you do that. They're basically cash equivalents, and in some cases they're very expensive. If the company becomes very successful, it's these people get compensated very well. But there's a lot of risk. So risk adjusted compensation obviously is probably a better concept. And the bottom line is you can't do it without your early employees, your early team. So you need to find these people that will help the entrepreneur, the founder, the founders, if there's a couple of them, make this vision a reality. They have to be paid below market rates for a couple of reasons. One is, you need to have them so that they show commitment to the company, and more practically, the company doesn't have the cash, so you just can't be paying people full market rates or above, since they're startups, and if people are really looking for a paycheck, startups are generally not where they go. They'll go to a more secure position in a larger company. So you get them now, you pay them below market rates, but you overcompensate them with the increased value of the stock options in the successful company that they help build. All right, so how does the stock allocation work? So typically the founder or founders get 70 to 80% of the stock, and then you create a pool of about 20 to 30% that you can give to these team members based on the relative value of what they're going to add to the company. Stock options are used, as I said, to compensate early employees in lieu of the cash until the investors can fund the company fully. So here, let's take a quick example. So let's say you carefully select 5 key early employees. These people have to have the skill sets needed to perform the specific functions in the business plan. If you don't have a business plan, or the original founder can't do it, well, then you have to find 1 or 2 people that really are co-founders to help build that business plan. But once you have that, you have to have these team members who believe in the vision and who are willing to work for the company until the funding, maybe for free, probably for free. And even after funding, the investors expect to see a large portion of their compensation tied to the success of the company, which is what the stock options do. So even after funding, the employees are generally paid below market rates and made up again with the stock options, which is the way to motivate and incentivize people to create the value. So the founder executes employment agreements. So this is the key part. So once you have the stock options that are basically cash-like, you can use those as consideration in the employment agreements. So the founder or founders can agree with employees to do specific tasks, to allocate so many hours per week, just like they would if they were getting paid cash. Usually in the earliest days, these are part-time positions of 5 to 20 hours, depending on the situation, and if they're co-founders or if they're more strategic employees or key employees. But somewhere between 5 and 20 hours is generally suitable. There has to be a full-time person, so that's the founder of the founder team. But people after that, generally 5 to 20 hours, depending on their situation. If they can't offer you 5 hours, I mean, everybody's got 5 hours if they want to do this. So you should easily find people that'll give you 5 hours if they want to work for the company later after the funding. And if they don't, that's a counter-indication that it's probably not going to work out. They have to be very flexible and they have to be committed. The stock options that they receive can also be stipulated in the agreement. And then really what you do, which is different, is you set up a condition in the agreement that converts the part-time employees to full-time once it's funded. And you have your predetermined salaries and stock options already going, right? It's all set up at the beginning with the stock options and the employee agreements. And then it just triggers on funding. So what are the benefits? Why is this important? Well, the benefits are the employee agreements are executed with full terms. So the team can start working together part-time, producing early milestones. Now those milestones could depend on the time and the industry. You can do more in software, obviously, than you can in creating cars, for example, in the early days. But there's always something that can be done basically with the sweat equity of the team. So the agreements also provide the seamless conversion to full-time when the funding is received. But this is the key part, right? Investors now have an ability to see how the team works and does it work together well, and can it deliver even early, smaller milestones. This is very important because that's what's going to create the value. If this team can work together and put together something basically from nothing, and that is not easy, and not all people can do it, and not all teams can work together. A lot of teams blow up, even if they get the money. They just can't work together very well, and just burn through the money and then it just falls apart. Another reason why you want to do it, you want to sequence it like this, is without an executed agreement, you have the risk of employees not really taking it seriously, especially about leaving a current position for a risky startup. And so they'll say, sure, you just get the funding and, I'll be there. But what happens, and I've seen this, innumerable times, it's actually pretty common, where when the money comes in, one or more of the team just says, you know what, I have a family, I have a mortgage, I can't do this. I need the stability or whatever it is. There's always something where, when they really look at leaving and thinking about the risk reward, they just can't do it. Well, that's not necessarily a moral failing, except you kind of need to know that as the entrepreneur, as the founder at the beginning, because that will kill your deal. If you're selling, your team to the investors, and then your team starts to fall apart, you will not close that deal, because they need to see those agreements in place. And as soon as those agreements start falling apart, they naturally, don't have confidence in the team to deliver. They couldn't even deliver the team, which is not the hardest part of all of this. All right, so that's the reason. That's kind of how you do it in the big picture. But let's get into a little bit of the specifics. So, in setting up a stock option plan, you need a C corp. I know a lot of startups create an LLC to start, but it's really the wrong way to go if you're really trying to be a venture backable startup. LLCs, S corps, they're more for closely held companies that are not looking for investors. So if you're going to go for investors, you need a C corp, but you also need the C corp to be able to do the stock option plans, because if you don't have a C corp, it's hard to have the governance to actually have investors and the employee stock option plans. With a C corp, which is usually done in Delaware, Delaware has a big history. A lot of them are done in California too, but because there's a lot of people out there, obviously, that are going in their own way in a sense. But Delaware is the traditional state where C corps are set up, and then you have the structure in place that's well known to bring in investors pretty easily and to have these stock option plans to get started. Stock option plans can be set up anytime, but it's just a lot easier and cheaper to do it when you incorporate it. And I'll get into that a little bit. So setting up a stock option plan, so you need to legally authorize sufficient amount of stock for founders, for employees, advisors, consultants, and then investors. So you kind of need to look forward and figure out what you're going to need to do. If you don't have enough stock authorized when you incorporate, this is why it's easier to do it all at once, then you have to go back and you have to get a certificate of amendment to add the additional stock. So if you're looking forward and you're going to need a stock option plan and you're going to have investors, you just authorize the stock that you're going to need to do that. You could change everything, but it's always time, money, and it kind of shows a lack of sophistication to investors and to the employees and advisors and consultants. So do it at the beginning. If you have the authorized stock, then it's still not completely easy, especially if you've moved along a little bit and there's multiple stockholders, but it's doable. So if you have the stock available, you can allocate some to the stock plan, and you just need a board resolution and shareholder approval. If you do it at the beginning, the founder basically just sets it all up, and there's no going back to get stockholders that don't want to go along or don't want to approve it, or some board members that you can't find or are on vacation and just slow everything up. All right, so let's go on to the next. Here's another example. So let's say you incorporate with 20 million shares, and that's about the right number if you're going to get investors. again, if it's going to be a closely held company, it could be 2,000 shares, right? That you distribute among the 2 or 3 partners. But that's not what's being built here with the venture backable company. What you need here is shares to give to investors. So basically, these are just rough numbers, and it obviously could change, but it's not uncommon to see like 7 or 8 million given to the founder or founders. Then you allocate 3 million into a stock option plan, basically a pool that you give to employees, advisors, and consultants for about 10 years, right? These plans, most of it is given up way before the 10 years, but these plans usually run about 10 years. And then you reserve about 10 million, so that allocates about 10 million shares out of the 20 million. Then you have another 10 million for investors that come in your different rounds. You can always change this later, but it gets really hard to change it later, because then you have to, if you need to get more than 20 million shares, you're usually in pretty good shape because you have 10 million shares to investors, so there's money. But it could change, and then often will as the company goes through the different stages. So the 3 million shares in the pool, this is what's used in the employment agreements to compensate the early employees before funding, and actually they get shares after funding too, because the investors want to make sure that they're committed, they're going to stick around. The last thing an investor wants to see is the money goes in and then people leave after they've invested, or within a year of them investing, because usually there's multiple years, 3, 5, even more years of development that needs to happen in the startup, and these are the employee they're counting on to deliver. To just some legal things, stock option plans need to be legally documented, obviously in writing. They have to be adopted by the board of directors, and they have to be approved by all shareholders. If appropriately structured, you have tax benefits, which is very useful, obviously, because if there's taxes due on the stock options which aren't convertible into cash, then it's really hard to pay your your tax bill. That has to come out of other money to pay the tax bill. So that creates a lot of stress, and a lot of times employees just can't do it, right? So they either don't get involved, or they will leave because they can't afford the tax bill. So it's really important to set these up properly so there aren't taxes. All right. Vesting, hopefully a lot of you have heard of this already. Vesting is a term in the stock option plan. So you want to make sure that the team members that are adding value stick around, as I was saying. So to ensure that you have a vesting schedule. Usually it's about 4 years with a 1-year cliff. So the 4-year vesting basically means the team member needs to stay with the company for the full 4 years to get all the shares that have been promised them in the agreement. And it's usually vested over quarterly or monthly after the cliff. So the cliff is, you don't want to start giving out shares to people that aren't going to be around, because that just messes up the cap table. So the cliff means that if the team member is terminated, either because they voluntarily leave, or they're fired because they can't get along with people or aren't delivered, they don't get the shares, right? This is usually done after the funding, and I'll get into this a little bit here, but basically it's a probation period to make sure that the team can work together, so without complicating the cap table. If the team members aren't getting cash at all, a 1-year cliff is way too long, right? I mean, if they're getting a below market salary, a 1-year cliff is okay. That's the cost of being able to play in the game to get the upside of the shares. So 1 year, they need to be. It could be less than 1 year, but it's traditionally 1 year, could be 6 months if you know, in certain circumstances. But 1 year is probably appropriate, because they're, you know, below market at that point is probably 75–80% of their salary that they could get somewhere else. You know, that is a bit of a discount. That's the risk they need to take. Both sides take risks in having this team come together. And you know, it's totally understandable that the startup and the other team members shouldn't be saddled with somebody that doesn't work out. But if they're not getting paid at all in cash, then these are really early part-time people. A 3-month cliff is probably fair and is more common. So if before you get funded, you still won't need to test people, give them a probation period, but you can't expect them to work for a year for nothing. And then if it doesn't work out, they walk away with nothing at all. It's a tricky thing because you don't want to have your cap table messed up. So it goes back to the very beginning when you put in your team together. You want to make sure you find the best people, because it never gets easy to change it up. So you want to be careful before you sign those agreements. But there are, you know, these little escape hatches to make sure you have a team that can work and deliver. All right, bottom line, stock options can be used as cash substitutes for unfunded startups without the cash to pay for early team members. They allow founders to start building their teams before they get the funding. They provide for and compensate for early milestones by using sweat equity by the team members. And this is most importantly, this is how you get the money, right? When the investors can take a look at the team and see that they're holding together, that they can deliver little things without blowing up. And so it really, the job for them is to invest in the company so that they can go from part-time to full-time and just accelerate what they're doing. All right. Okay, this is our startup services again. Just to let you know, if you're interested in any of this, now that you know a little bit more what we're doing and how we do it. If you're interested in setting up a company with a stock option plan, let us know. If you already have your team put together and you need some startup development officers to help you, these are very sophisticated people that have done it before. They're either ex-entrepreneurs, some of them exited, you know, with hundreds of millions of dollars. Some of them are angel investors, and some of them are ex-corporates that help line up to the corporate members that we have. If you're looking for, if you don't want to use our SDOs, you can still submit your startups, and we'll show our corporates to see if they're interested in sponsoring any research, licensing, joint venturing, or other strategic alliances. And then if that happens, then the angel group is only for ones that the corporates say they're very interested in working with and seeing milestones develop for their business units. All right. If you're interested, here's the email, and there's a calendar online that you can just set up and find a slot and set up a call with us. All right, that's me. And Q&A. So Ria?
Thank you, Tony. And we are now formally opening up the floor for questions. All right, we do have a few questions lined up. Again, I'd like to remind everyone, in order for you to submit questions, all you need to do is type in your question in the Q&A box of your GoToWebinar control panel, and you will find that on the right side of your computer screen. All right, so let's see. Our first question is here. What is the structure of an agreement if an institutional investor comes in and asks to replace people in the team? Does the replaced person still have their stocks?
Yeah, so if the stock is vested, they have it, right? So this is what I was talking about in those slides. So there's a time, you know, there's the cliff, before it locks in. And then if they don't stay the 4 years, they only get prorated whatever they've done. So if they've done 2 years, they'll get 2 years worth of stock. And so, but that becomes theirs. There's, you know, it's like cash in a sense, with a few minor details. What is the structure of an agreement if an institutional investor comes in and asks to replace people on the team? Generally, they don't do that. You know, basically, if they're, usually this is much later, by the way, so this isn't early startups, but it can happen in series B and C. Usually they replace people when it's failing, right? Nobody touches it when it's working. It's when it's failing and people are starting to fear they're going to lose their money, they might come in and replace people. But you know, that happens, and you know, it's a startup that people have an obligation to there's duties of loyalty and duties of care for all the people that work at a startup, any company basically, especially the higher ups. So you know, if they're not the right person, or if there are people there that aren't the right people, for the benefit of the startup and all the shareholders, they're supposed to replace people. But it's not done easily. You know, investors don't come in to look for people. You know, that's really hard to do. Next.
Sorry, I was talking, but I was muted. All right. You do have a slew of questions coming in, so here's the next one.
Mm-hmm.
All right, hang on. Okay, we are currently an LLC with SBIR funding. Do we need to have a stock option plan ready should we decide to do an SBIR Phase 3? Phase 3 requires that we find funding other than the SBIR program.
So, I mean, none of this has to do with the SBIR program. You know, that's a government program. Investors are different, right? The SBIR program doesn't really need you to have a stock option plan or employees in place. And you know, you have SBIR funding. That's another way to start your team. So I'm glad you brought this up. Actually, I didn't have time to talk about it in this webinar. But SBIR funding is really good, right? It allows you to do what stock options allow you to do, which is start to put the team together, get it working together, and in this case, you actually get to pay them. The one thing about SBIR funding is if you ever try to transition to investors, you really should do all of this planning at the beginning, because it's hard to switch from SBIR to a venture backable company, because the people aren't necessarily the right people. Again, you know, because you have cash, people are more willing to put in the time, but that may or may not end up really building a team, right? They might leave as soon as the money runs out. But it is a great way to start funding the team. And if you marry it with, you know, what I'm saying with the stock options, it can really be pretty powerful. I would still start with the stock options because you want those people that are going to stick around. And then, you know, if you get the funding, give it to the people that are going to stick around and want to see the vision come to fruition. So SBIR is good for that. But did I answer the question? Yeah, I mean, you don't need to worry about the stock option plan for the government. They don't care at all. And Phase 3 is really not an SBIR phase. It's what they call when you have to go out. So if you're going to go out, you should have it in place because you're going to have the same problem. You might have moved a little bit because you have some team members and you can say we work together, but after that Phase 2 money is used up, a lot of those people will leave, right? Especially if they're consultants. None of this is about consultants as your key people. Consultants could fill in some gaps you have, so you don't have to do everything, but you need to build a team that represents the company, that is the company. Let me just say this now that it kind of came to my mind. If you're going to sell the company to exit, right, to a corporate, they want your people. So you need, I mean, they want basically what they're looking for is the patents, the product that's selling something, right, in the market. It's product testing and market testing. So they want to see a product that sells in the marketplace, probably of a few $1 million. And then when they buy it for $50, $100 million, what they're buying are the licenses, sorry, not the license, the IP, the people that created the IP, and the future of that company. So you want to make sure you have a team that will go along with the company if they want to go along with it, and also can deliver. All right, next.
Okay. Next, how much employee stock ownership plan in percentage should you allocate initially and in other investment rounds thereafter? Is it pre or post money?
Yeah, I wouldn't overthink it too much. Your biggest problem is getting the employees to agree to these things. And the better ones are going to ask for more money. The ones you really want are going to ask for more money in shares. If they're going to do as much as the original founder, they might become co-founders. You might be splitting that company in that case, or it could be 60-40 for the founders, right? You still have the other employees that you have to get. So I wouldn't overthink it. It's really all negotiations once you find the people, and finding the people that are going to help you deliver on your business plan is not trivial to begin with. Most people, are 9-to-5 employees and don't want to, don't care. You have to find somebody that cares about what you're trying to do, cares passionately enough to forego some salary, and believes enough that they're going to get compensated, in spades later. So that's the trick. Then once you have that person, it's going to be a matter of negotiation as to what they're willing to accept. And it also depends on, what the original founder or the earlier team members are adding already. It's all negotiations at that point. No cookie cutter. It's all negotiations. Okay, next.
Yep, next question. Could you say a few additional words about the potential tax problems that can arise for early employees receiving stock options?
Sure. So I'm not a tax person, but the rules are generally that stock options, if they are allocated at market, and that's the hard thing. How do you know what market is when it's a startup? So when it's at the beginning, it's zero, basically, right? Or very de minimis, pennies. So it's pretty easy to allocate stock then. But after you start doing things and get awards or get sales, can't stay at zero. So you have to figure out what that value is. And that's the tricky part. So if it goes to, let's say, 10 cents or 50 cents a share, that's what you have to allocate it at. Otherwise, they get options that are in the money, so to speak, and then they're supposed to pay taxes on that. So as long as you get it below what the current market value of the stock is, there is no tax implication on the allocation of the options. And then even when you can kind of keep the options and convert them into the shares, keep the shares, which are also without taxes, and only have to pay when you sell the shares. And when you sell the shares, that's not a problem because you have the pool of money to pay your taxes. So it's only a problem when you can't match up the cash coming in from the shares and options with the money that has to be paid on the taxes. So there are these tax deferrals, and it's just you just need to do it properly. And it's not hard to do it properly, but you have to know it's a trap for the unwary, right? You just need to make sure that it's done properly, and you won't have a problem. Okay.
All right. Okay. Our next question is, we have here it is. We have an LLC. Why is a stock or units option not viable?
Yeah, I usually get this question. It's not that it's impossible. You can do it, but you have to, it's all from scratch, right? And again, investors are not going to come in later to do it. Like institutional investors, they won't invest in LLCs. They don't want the tax implications that you have with an LLC. They want shares. So it's doable. Everything is doable. You know, it's just how much do you pay? How much trouble is it? And you know, why go the hard way, right? Just convert it, because you're going to have to do it when you have investors, and it just shows sophistication when you use the C corp. It's made for that, right? It's made to have investors. It's made to have officers. It's made to have board members, right? You could have the option plans. They're specified as to how those work. Whereas when it's an LLC, LLCs are basically partnerships, and you have to write it all out, and then somebody has to read it, and that becomes a huge problem. When due diligence, you have to read it. So it just, unless you like paying lawyers' fees for things that can be easily done, I don't think doing the LLC is gonna be a good idea. Go ahead.
All right, our next question is, oops, there you go. What is the common level of stock value granted relative to a market salary?
That's all, again, negotiated. You know, so I didn't have time to get into it, but basically the startup starts at zero, right? Zero value, so the stock doesn't have any value. Then, you know, you start adding people. So the founder, if that's a PhD, especially if it's a PhD that's full-time for the company, you know, you can make a case that that company has gone up to $250,000, right? Because it's got an employee that's going to be doing something, or it's got a high-level employee. If you add another couple of PhDs, you could say it has, you know, $1 million worth of value, right? And then you just divide that to, you know, what you want to make up, and then you also figure out what do you. So from the $1 million, what is this person going to add, right? Because it can't just be salaries; it has to actually be value, because products get created, or, you know, some kind of milestones get done towards something of creating value. So you kind of, you know, look at that and try your best to allocate what's fair to everybody. What you really need to understand is, you know, these stock options are not going to be valuable unless the company is valuable. So it's what does it take to get it, you know, to a place where the company is valuable? Well, you need the people, and to hire the people, you have to negotiate with them, and that's why it's hard. You know, sometimes it's just the people are going to go, it's not worth it. So it's really hard to say, I'm going to take you know, this big salary cut, you know, with all the risk, you know, and believe that the company is going to deliver anything in the future. It's a special type of person that starts a company. That's the founders, that's the early employees, and then even the first 10. You know, these are the first 10. It's all people that want to do it because, you know, they're crazy, I guess. It's not people that are looking for the salary and are willing to forego something to make something and be part of something. All right, next.
During incorporation, say we had 10 million shares and all were assigned to co-founders. If we need to add team members or investors for stocks, how easy or difficult to adjust the stock arrangement?
Yeah, these are all, you know, these all become legal agreements, so it's not easy to adjust it. It's like if you tell somebody you're going to pay them $100,000, you can't say, well, later you want to adjust that. So, you know, you're kind of stuck with it. Adjustments can be made. It's not like you can't adjust. You just have to get everybody to agree, right? And people on the other side are generally not going to agree to give up shares. They'll take shares, extra shares, but to say you have to get a haircut, that's a difficult conversation. It happens. Usually it happens when the investors say, you know, the company's not worth what people thought it was worth in a down round, and then things have to be adjusted. But you know, it's never going to be easy, because people have to give up things that they expected and were entitled to. But this is how you have the leverage that I was talking about. Once you get moving on this to do this stock option plan, or to get approvals for that, when people have to give approvals and maybe they want to get out, they can hold it up. And that's what happens, right? You can change it as long as everybody agrees, but if people don't agree, and it's going to be very hard, the more people you have, and the more you've done, to just get everybody to agree easily. Next.
If one of the co-founders decides to give up his founder shares before the 4-year vesting period, should his shares go back to the outstanding share pool in the cap table? Any thoughts?
Yeah, so if they're getting the shares out of the pool, you know, they just don't get allocated, right? So it's not that they give them back. It's that they don't get them, right? So the founders, though, you have co-founders and founders. So the founders, this could be done different ways, but sometimes they just get the shares. And this is the reason, and actually this is the reason why you just don't give people shares easily, because you don't want the co-founder to have shares that have vested, and then you know, you have to crawl them back. You could do that. They could be restricted shares where you get them back. But if you're going to do that, it's just easier just to give them the options, so they don't get them until the vesting period has lapsed, and then, you know, they get their shares. And if they leave, whenever they leave, they get whatever they've been entitled to according to the agreement. That's interesting. If you could, oh, okay. So it says, have I been reading these? I don't think so. Is it you? I thought you were reading them, Maria. You're going to read them or not?
Sorry, I was muted again. Here we go. Do you see them? Yeah, it's a recommended to vest based on the achieved milestones instead of time.
Yeah, that's interesting. I mean, that's negotiable, right? It's totally negotiable. It could be. It's not traditionally done that way, but it could be done that way, because people are giving time, right? It's like paying salaries. These are employees. When you pay employees, it's not really milestones, right? You hire them, you pay them, you hope they're going to do what you're expected them to do. It's a little bit different. Milestones are more for contractors, right? So those people, you give them a milestone, and you generally don't control the way they do it. They're just supposed to do the milestone. That's not necessarily an employee, and you know, you need to. This team building is the trick. So I'm not sure milestones gets the team to work together. That first 5 to 10 people, they have to be the team, especially the first, you know, whatever, 3 to 5. I mean, they're going to make it or not, or the company's going to fail, because you just can't put in structure, you know, for the employees without having people that will fill in the gaps while you're trying to build that structure. So if you could do it, I would think about it, but more traditionally, it's just you give them time. But, you know, in the employment agreement, you could say you have to do X, you know, this milestone in return for these shares. But I'm not sure I would do that for the first, you know, few. You might do it for other ones. You definitely do it for consultants, by the way, right? So if that's what you're thinking, what's the difference between team members and consultants? Consultants don't stick around, right? They're not employees. They do their job and they go. And so that they, you know, part of the value that gets created is the teamwork, right? Especially if the corporate is going to end up buying the team members, especially the scientific team. So, the team members in an acquisition go along, not all of them, but the key ones creating the products, they go along with the purchase. And so you don't want those people to be consultants. All right, next.
If an institution starts a company and invests cash in technology development, what will be a reasonable allocation of equity to the hospital?
So invest cash in a technology. So that's usually what they do, right? They do the R&D, and then there's a spin out. So if that's the case, there's usually a licensing agreement, and again, negotiable. It just depends. What you need to be careful is that it's not so onerous. Well, if they take equity, that's fine, right? They're almost like a founder. So I've seen 5-10%. Just depends. I've seen 50%. So it just really depends on the parties. But if that's what they're giving for equity, you need to kind of value the asset. But usually what they do is they give a license, and the license is different, right? It's not for equity. Usually it's the cash royalty that they're looking for off the license. You need to make sure that's not so onerous that it dooms the company going forward. And dooming the company means the investors are going to say it's too hard to make any money, so they walk. So that first licensing agreement can actually be a problem if it's too onerous. But if you're talking about equity on top of that license, because usually they have to have the license, right? Under Bayh-Dole, they can't assign it, so you have to have a license. And you just have to figure out what the value is in lieu of the license if there's no royalty, and allocate some equity to it. If they're coming in as founders, if they're coming out at the very beginning, because that's what you need to see, right? There's founders, there's early employees, there's later employees, there's consultants, there's advisors. So founders are different. They're the ones that pony up the money and the idea. Pony up the money in the sense of whatever it takes to get it off the ground. All right, next.
Okay, let's do a quick time check, Tony. So we probably have time for 2 more questions, 2 or 3.
Okay.
All right.
Sure.
Okay, how do you handle a request from investors to revest options or shares that have already been vested?
Yeah, that's what I was alluding to before. So at the end, when as this goes on, the last money in kind of dictates what goes forward, right? So if you need the money or the company just dies, then people really have to make hard decisions, and sometimes they have to give up things that they don't want to give up. And so again, it's all negotiation and leverage. The people that have the most leverage are the people that are putting the new money in, and everybody else usually suffers, right? This is especially true when there's a down round. As long as everything's going up, it keeps growing, and the new money comes in, and everybody's kind of happy. But as soon as things turn around, it gets nasty, because the new money is coming in with fresh money, and things are going the wrong way. So the last money that came in didn't achieve the value creation that they were hoping on, and so it just creates a tense situation. It all just depends on the investors and what the people want to do. They have their rights, and if they don't agree, the company sometimes fails because the money just doesn't come in, right? Or somebody holds out, and somebody else, some of the earlier investors or the founders make that person happy. All right, next.
Okay. Should a person who leaves have to exercise their vested options when they leave, or are they allowed to exercise them later?
So yeah, that's a great question. So underpinning all of the stock option pool is like a 20, 30, 40 page document. That would be in there. It could be either way, right? So when the stock option plan is created, it'll say what the terms are. And also the employment agreement can narrow that even more. So it could say that when they leave, they have to exercise them right then. Or it could say they have, the full 10 years to whatever's left out of the 10 years to exercise them.
Okay, I think that's all the time we have, Tony. Time to wrap up. Do you have any last words for our audience before we close today's session?
No, I think we've covered enough. So why don't we give them a break?
Okay, good idea. All right, so before we close today's session, again, a reminder for those on the call, the slides and video will be available. We will inform you via email once they are available to be accessed. Now, as Tony mentioned, if you would like to connect with us after the webinar to talk a little bit more on how we could work together, all you need to do is email us at startupdevelopment@nset2.org or use this link to schedule a call. Again, this information will be provided to you in an email. So if you would like to follow up with us, if you'd like to have another conversation, then we would be happy to set up that call with you or to talk to you guys about it. All right. So we'd like to thank our audience for joining us today. Thank you for all the great questions. We hope you learned a lot of valuable information in today's webinar. And Tony, thank you for your time. That was a great talk, and we are looking forward to connecting with everyone again. Thank you and have a good afternoon.
Thank you, everyone. Have a great day. Bye-bye.